It's been a year since bond or car loan repayments dropped. In that time, consumers faced higher taxes and steeper fuel prices. More jobs were also shed. But analysts say the ground is now fertile for an interest rate cut. Inflation appears tamed at desired levels, economic growth is weak, and global central banks are cutting their rates as well.
I think the 25 basis points will allow consumers, firstly, that have quite a bit of debt to pay off that debt because rates are a little bit easier, a little bit lower. And for those that have capacity and appetite, I think like we've seen over the past couple of months, where we've seen that households now are starting to demand a little bit more credit, the lower interest rate will allow them to do that.
Anyone with a R1,000,000 bond and a prime rate of 10.25% is making monthly repayments at the moment of R9,816. If we guess right, and the interest rate drops by 0.25%, there will be an immediate saving of R166. That's almost enough to pay for a family chicken meal at a popular takeout. If we do get an interest rate cut, you will see the cost of your borrowing at banks come down, even if it's just a fraction. But don't expect several to follow. Rate cuts alone cannot repair the broader economy.
It's not going to do much to get the economy growing again. I think there again you need very prudent, policies to lift economic growth. We need to see investment spending. We need to see some of these structural reforms also being implemented.
This latest rate announcement comes hot on the heels of Lesetja Kganyago's reappointment as Reserve Bank Governor, and the bank's repeated affirmation that its independent mandate is primarily linked to keeping inflation in check. Devin Murrigan, Johannesburg.